Good morning or good afternoon, wherever you are in the world. Welcome back to another session of Market Mondays with myself, Daniela, and Kyle. We're both senior market analysts at Capital.com, and we're here today to take you through some of the key events of the markets and looking ahead at what to expect this week. Kyle, good morning. Do you want to say hi?
Yeah, good morning. It's great to be back and it's great to see you again. Obviously, a lot going on in the world, so we'll dive in.
Yeah, let's start quickly with the risk warning. Just, I'm sure most of you know, but just be aware that the products that we do offer, so CFDs, and for those of you in the UK, spread bets as well, are complex instruments and they come with a certain level of risk. You have to be aware of these risks before trading them. Carl, over to you on the other commentary.
Yeah, sure. It's just to say, obviously, this is general information only and doesn't take into consideration anybody's personal circumstances. And of course, yes, CFDs are a risky product, so you must consider yourself whether they are appropriate for you.
Let's get straight into it. As you said, very busy week this week, Kyle. So we do have a shorter calendar just because we want to focus on what's been going on in the world. Obviously, point number one, geopolitics dominate market sentiment. So we'll look at exactly what's happened with the escalation of tensions in the Middle East and now the US involvement as well. Then we'll look at specifically oil, gold, and the dollar. So it's interesting to see the dynamic in markets. Just from the offset, oil shot up. Gold is struggling to find momentum, even as a safe haven, as we'll talk about in a second. The counterpart to that, of course, is the dollar. The dollar seems to have finally found some footing. Well, that's going to be long lasting or not stands to be seen. But those are three of the key markets that we will cover today because those have probably some of the closest ties to what's been going on. And just as a quick recap, we don't want to dwell on the past too much, but we did see three key central bank meetings last week: the BOJ, the Fed, and the BOE. So Japan, the US, and the UK. All three left rates unchanged, but we did get very different messaging from all three of them. And of course, that can impact some forward guidance and market sentiment as well. So we'll do a quick recap of that. But let's, before we bring some of the slides up, Kyle, let's just focus on what's been going on in the world. Because as we know, geopolitical tensions have escalated. The focus has been on the Middle East. We already had that last week, but of course, over the weekend, we've seen the US involvement with President Trump confirming that the US has attacked three key nuclear sites in Iran. We haven't actually had the full debrief of that, but it does seem like the damage has been extensive, therefore damaging Iran's nuclear power. From the Iranian side, we have actually seen the parliament vote in favor of closing the Strait of Hormuz, which is a key strategic pathway for a lot of the global trade, specifically oil as well. I believe something like 20% of the world's supply of oil passes through that strait. So significant threat of retaliation to somewhere there. Now, markets are questioning whether they're actually going to go through with that or whether it's just a case of the words before actions right now. But so far, the reaction in markets has been quite intense. Over to you, Kyle, first on what are your first thoughts on this?
Well, first thoughts are that obviously it's a fairly significant escalation in the conflict and obviously embroils the United States. The critical question becomes, to what extent does this become a broader regional conflict that more deeply involves the US and perhaps US interests and assets in the region? And then more specifically, as you've already said, whether it will impact global energy supply, mostly through a blockade of the Strait of Hormuz. At the moment, the markets are behaving in such a way that that risk is heightened but relatively limited. Oil prices are only up 1% for the day so far. We've got it pulling back from as high, as much as a sort of a 3 to 4% rally where it gapped up at the Asian Open last night. But if you look at some other barometers of risk appetite, geopolitical risk specifically, gold prices aren't really perking up. The US dollar is picking up, which kind of makes sense. It's a liquidity play, but also in these situations where you do start to see some energy volatility and an increase in energy prices, some of those currencies, especially in the G4 landscape, like the yen and the euro, which belong effectively to economic blocks that are, net importers of energy, start to suffer just at the margins. But overall, really the markets are basically betting that the situation will not worsen to the point that it has a significant inflationary or growth risk across the global economy, sort of vis-a-vis a larger, broader war or targeted attacks either on energy infrastructure or obviously blockades of the Strait of Hormuz.
Yeah, I agree. To me, also, I think here is a lot of the politics side of it also plays into it. As we see, sentiment is not deteriorated. We'll look at the charts in just a second, but it hasn't deteriorated to the point where, as you were mentioning, this fear of retaliation becomes translates into a wider conflict in the region, but also with other international allies coming into play. But I think we've got to look at some key factors here. First of all, the fact that Iran's nuclear program has been significantly hit, therefore likely pushing it back several years, and that of course affects its ability to also retaliate. It seems to have lost control of its skies as well, which I don't know if you've been following the news, but a lot of the talk about the attack that we saw over the weekend was the fact that Iran wasn't able to identify it before it happened, even though supposedly having full control of its skies and monitoring. So therefore, again, that plays into that lack of likely retaliation. Also, a lot of its proxies or its allies in the region, a lot of the Islamic States countries have also faced weakening in the last few years because we've had other conflicts in the area as well. And also Russia, a key ally as well, also with the issues that we've been seeing with Ukraine, also unlikely to join if this were to become a wider conflict. So kind of those points does play into the fact that it's unlikely that this will retaliate. Also, something to keep an eye out for is if they were to close the Strait of Hormuz, which seems right now that the most possible step from Iran, even though unlikely at this point. China is a big ally for Iran in terms of oil consumption, and it wouldn't benefit China if they were to do that, and that of course is likely to deter Iran from any likely reaction right now. And I think that's where markets are seeing some of this lack of, I guess, fear in markets right now.
Yeah, I think the final point's the most relevant one too, Danny, because I've done a little bit of reading, obviously, as we all have over the last sort of 24 hours or so. And not only would the blockade of the Strait of Hormuz be, negative for some of the country's key allies across the world, powerful allies, but also it would be somewhat a case potentially of sort of cutting your nose to spite your face, mostly because the Iranian regime relies on energy exports to be able to fund itself, and obviously the economy is ultra dependent on it. If hypothetically there is that blockade, it would inevitably have the blowback of energy markets, of oil revenues, energy revenues drying up for itself as well. So the question more or less becomes, at what point does it become a rational decision for the Iranian regime to blockade the Strait of Hormuz, given that it would be inflicting a fairly significant cost upon itself? And I think the markets have come to have done the arithmetic and it come to the conclusion that currently, although it has retaliated by further strikes on Israel, and there are obviously retaliatory strikes still going on between the two countries, that maybe it will wish to target some US interests in the region, whether they be military bases in Iraq or other things to send a message. The probability of a significant supply disruption in energy markets from a blockade is fairly limited because, at least for now, the cost wouldn't be worth the benefit for Iran, likely, and that there are too many interests aligning to keep with its allies to keep the shipment lane more or less open.
Yeah, I agree. In any case, if there were to be a blockade of the Strait of Hormuz, as we said, highly unlikely at this point, markets reflecting that. I do doubt that it would have a long-standing impact. I think we would quickly see military action in the area, specifically from the US, likely, and trying to look for a swift resolution. Whether that would happen or not, of course, stands to be seen. But not only is it highly unlikely, as we've been mentioning, that the blockade is going to happen at this point, or seems like it's going to happen, but also whether that would have a long-lasting effect on energy prices also stands to be seen. I guess that brings us to our next point to discuss, which of course is specific assets and how they've been reacting. Specifically, let's start with oil. I'll pull up the chart in just a second. We've already mentioned a little bit the impact. It seems pretty straightforward, as we were saying. Just specifically at the open, we saw that jump higher because of expectations that we could see disruption in the oil supply. As we're saying, not much of a move this morning. In fact, actually suggesting a little bit of weakness there in that momentum. But of course, likely going to remain highly volatile. From my point of view, I think the threat of closure of the Strait is likely to remain for a while. Whether it happens or not, as we said, is a different story, but the threat itself does put upside pressure on oil prices. It's likely that we do continue to see oil prices remaining elevated throughout the next few weeks, potentially even months, if this situation continues to unfold. I think the only scenario where we see oil prices, this is a US crude, by the way, WTI. Let's say if you expect to see oil prices to dip back below where they were at the beginning of the June, so back below that, almost that $60 mark, if you see a swift resolution of this conflict and the threat of disruption to oil markets, which I don't exactly think is going to happen anytime soon. So I think, as I said, whether we actually see the action taking place or not, I think the threat of that action possibly being taken is enough to keep oil prices elevated for the foreseeable future.
Yeah, definitely. I mean, I think there's a slight risk premium being priced into oil markets at the moment, as well as other asset classes that we're seeing right now. But I mean, I think the equation is, fairly straightforward at this point in time, with sort of building on what you said before, that, because the markets aren't pricing in any sort of significant disruption to global energy supply, effectively, you could describe that as a level of complacency. And there's hundreds of thousands of barrels per day that flow through the Strait of Hormuz. So if worse comes to worse, and for whatever reason there is a disruption via likely a blockade, which again, despite being a low probability at the moment, is still a possibility, then that would have a very, very significant impact on oil. And that's when you might start to see these sorts of rallies and the gap that we saw occur last night extended upon, and the market push higher, notwithstanding obviously the second order impacts that could emerge from that. The big swing player will obviously be the Saudis and OPEC, and to what extent they'd want to support the markets with extra supply to almost tacitly consent, or endorse, the actions of the United States in its obviously strike over the weekend, and more or less trying to support the consequences of its actions, which may potentially be higher oil prices in the worst case scenario. So, I mean, obviously we're starting to see it on the charts, a little bit of a slowdown in momentum. So one expects, or one might assume, that without any further developments here, and if we start to see that, again, the markets have kind of expressed through price action that a localized war between Iran and Israel that doesn't target key energy assets is something that the markets are willing to tolerate reasonably well. We've seen evidence of that over the last few weeks. If that proves to be a fatal conceit, then you really would expect a fairly significant drop in oil prices, maybe testing those highs at the start of the year. But that's a tail risk at this point in time. So it's a low probability event with a high impact.
Yeah, and I think this brings us into our next key asset, which is one that we get asked on the weekly here on the webinar, which is gold. Of course, some people may be surprised at the momentum we've been seeing. We did have an attempted rebound last week, trying to get to that 3,500 area, which has been a key resistance for the last 2 months or so. We didn't manage to get there, quickly pulled back at the beginning of the week, and kind of had this bearish momentum throughout most of the week, even as these tensions have escalated. Now, as you were just mentioning, markets have tolerated pretty well the fact that this conflict so far has been very much has remained within the local borders. But even with the involvement in the US, we're not actually seeing that much momentum in gold just yet. Again, it goes back to the fact that investors may still be skeptical whether this is going to go much further, and therefore there's no real need to buy into traditional safe havens like gold, for example. But we've also got the flip side to this, which is specifically in this case, it's that gold is valued, is priced in dollars, and we have seen a resurgence in the dollar as well, which has been limiting the upside and putting downside pressure on gold, even as the first thought that comes to mind when you think escalations in tensions, geopolitical, you would think gold is a safe haven and therefore a rally in gold, which we've seen throughout many times in the last few years. we're not quite seeing that yet in the market. Again, it could be the fact that risk appetite remains pretty constructive and solid, even though fears have risen, as we've said, but not quite yet to the point where investors are fearing a wider escalation of tensions with other allies involved, even as the US has supposedly now entered the war. And even though indirectly they don't have any manpower in the ground, but it could be that, and it could also be, as I say, that the case of the dollar. Kyle, what do you think?
No, I just think it's mostly a signal that the markets don't see this as being something that will significantly impact the geopolitical dynamic globally. And it's the same sort of reason why we've got oil prices more or less pulling back, which is this degree of complacency about where the conflict will go from here. I mean, I think, you can kind of contrast it with events like the Russian invasion of Ukraine. You can contrast it with events like October 7, 2023, where in those instances where there was this very significant and reasonably surprising geopolitical event that was at risk of disrupting mostly global energy markets, but also global economic activity, is that you'll get a jump in oil prices, you get a jump in gold prices, and you get a jump in the dollar all at the same time. It's almost like the quintessential geopolitical risk-off trade. We've seen obviously a bit of firmness in the dollar coming through. I suspect that's more to do with the fact that there are other things at play at the moment in the macro backdrop that is, and maybe some technicals, which we'll, I'm sure, look at it in a moment's time, Danny, which has led the dollar to perk up. But we've got oil down, we've got gold down. I would say this is more of a signal that the markets are kind of looking through the events of the weekend. In the longer run, though, I still think that the gold trade is incredibly constructive, and I think for the most part, the trend lends itself to the fact that clearly risk is skewed to the upside. Momentum is obviously reasonably slow, as you can see on the RSI there. We're really not seeing that kind of very, very strong upside move on the RSI at all. But that 3,400, we'll call it 3,450 at this stage, where we've seen some daily closes in the past, and obviously some fairly swift sell-offs after that, is a fairly significant level of resistance, which if broken invites a fairly significant rally to the upside. But I mean, I'm still, because of the trade policy, geopolitical risk, downside risk to global growth, de-dollarization. I think gold is still a very, very good play. In the longer run, pullbacks obviously will occur, but I think that the circumstances are still constructive, and the fact that we haven't seen this rally today of the events of the weekend speaks more to the markets, again, desire to look through these things, if not arguably complacency.
Yeah, I agree with the long-term forecast. I think the momentum still remains to the upside in the long term. We've been mentioning several times how all of these factors play into the long-term sustainability of the rally that we've seen in gold. But again, I find it hard to justify that this pullback today and the lack of momentum is just because markets are forecasting that this is not going to escalate. I think there's also some other factors as well. And I think maybe, and we'll talk about this in just a second, but maybe the Federal Reserve last week as well, kind of playing into this fact that nothing really changed from the offset when it comes to the dot plot chart, still expecting 2 rate cuts. But they did flag a higher risk of stagflation, therefore more persistent inflation and downgraded growth into 2026. So fears of stagflation, and of course the impact that all of this situation can have on energy prices could also mean that consumers are going to bear the brunt of higher prices for a more sustained and longer period. That of course limiting a central bank's ability to cut rates. And as we know, gold very sensitive as well to a forward mandate from central banks and the likelihood of rate cuts or not. We've been pushing back on rate expectations from the Federal Reserve for a while now. As I said, they still expect supposedly 2 rate cuts in the next 6 months, but investors may be questioning whether that's actually going to happen or whether that's it for them this year. And that, of course, could also be playing into gold. I don't know. I think there's several factors at this point. I think, yes, investors are obviously not as concerned as they may have been about this current situation, given that it's unlikely that it escalates further. But I think from my point of view, I think there's also some other factors as well. But let's go into the dollar now, because we've been talking about it for a while. Let's take a look at how the dollar has been trading. So let's look at first of all the dollar index chart here. Kyle, what are your views? We've obviously seen it bounce away from these lows here, likely finding some resistance from under my point of view along the current levels. We've seen that in the past. It's been a tough level to buy into and a tough level to push above. And there does seem to be a lot of ready sellers at these points from the US dollar. Obviously, we'll have to look more specifically at individual pairs to look exactly at key levels. But from the offset, it looks like the dollar clearly oversold throughout this year, clearly reached an oversold area, which has managed to find support. It's now a question of whether this improvement in momentum can continue.
Yeah, and I mean, if you could do us a favor, if that's okay, Danny, and if we can get the RSI up, because I do believe that
Sure.
there is a bit of a bullish divergence emerging on the daily RSI as well. Which, yeah, so there you go. So you can kind of see there, and just to
Yeah.
kind of illustrate the bearish divergence there, is that you can see that, between April and May, we saw that very significantly oversold reading on the RSI, and obviously that was as the Liberation Day tariffs, caused a cascade effect in the dollar effectively. We have seen a lower low made for the dollar index, which sort of suggests that obviously the trend is still to the downside, and you'd be sort of wary of possibly betting against that, so to speak. But you're sort of seeing a series of lower troughs on the daily RSI, which is effectively higher lows on the daily RSI, which is effectively to say that some of that momentum is slowing a little bit. And although maybe there's a structural de-dollarization story there still going on, there's some very interesting, research around what's actually driving that, which is to an extent, a sort of reduced exposure to US assets by private investors, the tech stocks and what have you, because of US exceptionalism. The other stuff obviously relates to trade and, where many investors are trying to seek safety for, reserves and what have you, might be looking at the euro instead for a variety of reasons. But I mean, I think it's a really, all I think you can say for the dollar at the moment, at least when it comes to the dollar index, it's a fascinating inflection point because, obviously everyone knows the bearish dollar story. The US dollar, the US Federal Reserve meeting last week was actually quite a bullish narrative, I think, for the dollar at the margins, just because they were more or less pricing in a higher trough rate for rates going forward and a much slower pace of rate cuts going into the medium term. But nevertheless, I'd be looking at that kind of that bullish RSI, because if we start chopping through that kind of cluster of resistance that you noted before, Danny, at around 99, maybe the RSI manages to pick up through 50. Even if it's in the short term, there might be a little bit of an uplift continuing for the US dollar with the right catalyst, especially too considering positioning across most currencies is fairly bearish dollar.
Yeah, and I think a key pair to look out for the dollar for a while now has been the Japanese yen or the dollar yen. Both are considered to some extent traditional safe havens, but also I think the rate differential has been a key player for quite a while now, for over 2 years, I would say. And obviously with the Federal Reserve and specifically trade-related concerns weighing on the US dollar, and supposedly the Bank of Japan turning more hawkish, even though that's to be taken with a grain of salt, because it's hard to see the Bank of Japan ever be very hawkish, but has obviously led to that reversal in dollar yen, specifically since the highs back in August last year. We did see a little bit of a resurgence in the dollar towards the latter part of the year, but of course, since pretty much the start of this year, it has been a theme of downside pressure for the dollar. We have, however, seen that reverse higher. Now, a key area of resistance for the pair was that 146 level, which we were playing with it last week, especially on Friday towards the close of the session. Clearly, we've broken above it today, so finding some further momentum to the upside. We're also seeing the RSI also breaking above that high on that we saw in May. So again, potentially a story here of that RSI divergence. We'll have to see how this high plays out, whether we do manage to break above 148.50 or not. But for now, it does seem like the RSI is pointing higher. It seems like that move is also pointing higher. And this leads us again back into that central bank divergence convergence theory, where as you were mentioning, the Federal Reserve did kind of have a little bit more of a hawkish tone, especially towards the medium term of their mandate, of their forecast. Even though they tried to soften the blow, saying that they do expect rates to come down, as I said, the dot plot mostly unchanged for the short term. You can't help but kind of see that hawkishness from the central bank, kind of just again, once again, reiterating that the labor market is not yet showing signs of having to cut rates. Inflation, even though it has dropped in the last few months, still remaining resilient enough to be able to justify higher rates. And of course, with everything going on now and the threat that these events could have on short-term prices like tariffs, like the escalation of war, like higher energy prices, again, limiting the central bank's ability to cut rates, it has been a bullish story for the dollar. On the other hand, the Japanese yen seeing some weakness from the Bank of Japan, essentially turning dovish, even as inflation has once again proven to be more persistent than expected. I remember they last week they cut their tapering in half, their bond tapering in half, again, giving more liquidity to the market. That's a dovish signal. The Bank of Japan governor once again failing to admit that the rise in prices they've seen are ingrained in the local economy, and it's something that the central bank has to combat efficiently. They continue to justify it as transitory and external shocks into the economy. So again, that putting downward pressure on the Japanese yen, the central bank once again not taking, in my opinion, the situation seriously enough, considering markets are somewhat scarred with what happened with inflation during the COVID period in other economies like the US, like the Eurozone, like the UK, where central banks were thought to not take action quick enough, to be too complacent, and that led to a period of hyperinflation. Of course, the Japan is very different. They have battled with deflation for a long period of time, but again, the Japanese yen seeing some downside pressure from the back of that.
Yeah, I think it's sort of critical that the BOJ obviously were fairly concerned about market instability because of their quantitative tightening or tapering program. Inflation in Japan continues to run above target, but mostly because of, I think, trepidation regarding trade policy. The BOJ have been fairly slow to signal further interest rate hikes, although saying that policy in real terms, real rates are actually quite negative and therefore loose, that it hasn't shown a large degree of urgency, or certainly not as urgent as the markets were expecting last week in signaling further rate hikes. And when you get the combination effectively of, the timing of future hikes being deferred, as well as when inflation data last week came in a little hotter than expected and showed, an even deeper drop in real yields, that's going to lead to a little bit of punishment for a currency. So, yeah, that obviously the Fed's kind of, fairly clear language about its fear about risks to inflation going forward, and fewer rate cuts than previously projected in its SEP. It's become a bit of an opportunity. And to be honest, the moves over the weekend as well, as you can see this morning, have not been supportive of the yen. I think all of those that combination of factors has led to this kind of potential reversal now. And it'll be interesting to see at sort of what point does the rally get faded. Because for me, again, another long run story, I think the yen is still constructive because we're hitting a phase in the global economy that is much weaker, for the US economy that's much weaker as well. But nevertheless, there seems to be a reversion afoot, which, may have further to play out.
Agreed. So I think we've mostly covered the key themes for this week. As I said, geopolitical tensions at the forefront of market sentiment. So far, not having a massive impact on sentiment, but of course, we'll have to watch out to how this evolves. On the data front, Kyle, I don't think there's anything too prominent to watch out for. I don't know if you have anything on your eye on anything on the calendar this week.
Just the PCE reading at the back end of the week. Obviously, in light of last week's Fed decision, will be significant. We also get the final print of US GDP for the quarter, so we'll see to what extent the US economy contracted in Q1. But yeah, mostly that inflation data, because the retail sales figures a few weeks ago, maybe some jobs numbers here and there. Certainly, the business and consumer surveys have emphasize the impact of tariffs, but the US economy has been, remarkably resilient up until this point in time, given what's been thrown at it. So, if we start to see a little bit like the CPI release, some sort of evidence there of, well, the CPI release didn't have much evidence for the inflationary impacts of tariffs. Quite the opposite. It sort of suggested that the slowdown in economic activity was causing, maybe some prices to remain fairly depressed. But if we start to see the PCE, which is obviously the Fed's chosen inflation gauge, reflecting some of those concerns that the Fed clearly has that inflation will pick up fairly materially back above 3% by the end of the year. Obviously, that's going to be something that's going to catch the market's attention. So that'll be at the back end of the week, probably the climax of things, notwithstanding, obviously, any development on the conflict in the Middle East, which is very difficult to predict the timing of, as well as, still we've got 90 plus trade deals apparently in the works by the Trump administration. So we want to see developments there because one of the reasons that equities are right near record highs, in fact, some indices hit record highs, is really on this belief that the deals will come, the tariffs will be dropped significantly, and the Liberation Day volatility will be simply a thing of history rather than something to be repeated.
Before we go, Kyle, we do have one question to look at, and that is just someone commenting that elevated oil prices are risky for Trump as it could also cause bond yields to go up, right?
Yeah.
From the offset, yes, higher inflation expectations will supposedly feed into CPI further down the line, but specifically to bonds and specifically long-term bonds, they have inflation risk premium added into term premium, and that should if inflation expectations do rise on the back of these higher oil prices, higher energy prices, that can increase the yields on bonds. So yes, to some extent, that is correct. And also political implications for Trump. His mandate has been all on lowering inflation, lowering energy costs, specifically oil and gas prices, creating economic stability. All of this does seem to go against that in terms of you would see more increased volatility, higher energy prices, higher inflation potentially on the back of this. So yes, it is a risk to Trump, but yeah, that all stands to be seen.
Yeah, no, absolutely. Obviously agree with the premise of the question there, which is a major risk, as we've seen, is higher yields. We've seen sort of a fairly significant run up in yields in response to higher oil prices, and that sort of is a touch point for several of Trump's key issues at the moment, which is obviously trying to get interest rates lower to support the economy. Obviously, also trying to reduce payments on government debt, which obviously Trump has used as evidence or as a reason that the Fed should be cutting interest rates. And then, on top of that too, it does have a negative impact on financial conditions, mortgage prices, and what have you as well. So, clearly something that is going to be a consideration of the Trump administration, especially because people like Scott Bessent have spoken extensively about their desire to sort of target long end yields as a kind of KPI of sorts. You obviously always want to try and think as far down the line as you can when it comes to the second order effects of these situations. The thing is, will the US dig into its strategic petroleum reserve? There was some talk about that last week. It was sort of watered down quite a lot because prices are actually relatively low compared to where they were, say, 3 or 4 years ago. And then there's also the element of the Saudis and to what extent the US can leverage its relationship with Saudi Arabia to try and make sure that supply is basically protected, or at least if there's an upward spike in prices, whether the Saudis can step in and ease some of that, even if they can't fix it entirely. So a very, very interesting one to watch, an important thing to watch as well. And yeah, certainly something that might, to some extent, have a self-limiting impact on the Trump administration's decision making.
Well, thank you everyone for joining us again. We'll be back next week to take you through the weeks once again. Have a happy week and have a good trading week. Bye, guys.